Good morning, everyone. Thank you for dialing into the webinar today. So this is the second in a series of 3 webinars focusing on tax issues specific to Saudi Arabia. The first webinar, which was held last Thursday, covered the recently announced Gazette amnesty initiatives. So these were the initiatives aimed at assisting taxpayers who are suffering economically due to the impact of COVID-19. A recording of that webinar is available. Just contact any of the Keypoint team and we can send you the link. Our third and final webinar in the series will be held on Wednesday, the 13th of May, and that will focus on corporate tax and zakat. If you haven't registered for that webinar and would like to, just get in touch with anyone on the Keypoint team and we'll be able to help you with that. So your presenters today will be myself, Mark Gamble. I'm a senior manager in the VAT team. I'm assisted by Dao Han Hung, who's a manager in the VAT team. And as panelists, so chipping in with questions, with answers and any comments, is Mabeen Kadir, our head of tax, as well as Omar Hisham, a senior manager in the VAT team. So if you do have any questions throughout the session, feel free to type them in the Q&A box in the Zoom function, and either Mabeen or Omar will answer them, or we can take them at the end. If we don't get around to your question, don't worry, we will respond via email. So the talking points today will be, firstly, the surprise announcement of the VAT rate increase from 5% to 15%, which was announced late last night, and obviously caught a lot of people by surprise. So we'll cover that and the implications of that announcement. We'll also then cover the Gazette amnesty very briefly, as we previously covered in the webinar on Thursday. We'll also talk about VAT updates and some complex VAT issues in Saudi Arabia. But if you have any questions throughout, just feel free to ask them. So last night, the Saudi Arabian government announced a plan to increase the standard VAT rate from 5% to 15% with effect from 1 July 2020. So needless to say, it's come at a surprise to everyone. But let's have a look at what this means. So the announcement, it comes as a result of the impact that COVID-19 and the low oil prices has had on the Saudi Arabian economy more generally. So there's a few questions that I think are springing to mind on this change from 5% to 15%, which is quite a significant increase. So firstly, can Saudi Arabia actually change their VAT rate on their own accord? So the standard VAT rate was specifically set out in the GCC framework agreement, so the treaty or framework agreement as it's referred to. And as such, any amendments to the VAT rules stated in the framework agreement should be agreed at the GCC level. So there's a provision, Article 77 of the treaty, that says any amendments to the treaty needs to be agreed by all member states. However, ultimately, VAT laws are implemented at the country level. So there is obviously the ability for countries to change their own laws. And I suspect that's what Saudi Arabia will do. But again, what can you expect from the fallout of changing the agreed treaty without that consent of all member states? So I guess the following question would be, can we expect Bahrain and the UAE to follow Saudi Arabia's lead? So at the moment, there's nothing to suggest that either country will, but obviously we've been caught off guard with this increase, and perhaps the tax authorities in Bahrain and UAE have as well. But all GCC economies have been hit hard by both COVID-19 and the low oil prices. So both countries could benefit from the revenue derived from a higher VAT rate. So I guess it's kind of watch this space at the moment and see how these countries react. But certainly it wouldn't be out of the realms of possibility for the rates to be changed in those countries. Another question would be, what about the countries in the GCC yet to implement VAT? So the framework agreement does explicitly state the standard VAT rate is 5%. So the expectations at this point should be that 5% VAT would apply on implementation in Oman, Kuwait, and Qatar. However, should UAE and Bahrain follow Saudi and increase their rate to 15%, it might make more sense for all the GCC countries to follow with 15%. So again, it's a bit of a watch this space at the moment, but not out of the realms of possibility for any implementing state to use that 15% rate, or indeed another rate. Some other updates that have come out from the Saudi government as well, so in line with this increase to the VAT rate, is to suspend the cost of living allowance. So this will be suspended from the 1st of June 2020. They have also significantly cut the price of fuel up to by half for some types of fuel. So trying to pass that, I guess, that economic benefit onto the consumers, and have cancelled or provided extensions or postponed operating and capital expenditures for many government agencies and initiatives. So really trying to cut back that spending. So for businesses, I guess the question is, what should you do now, given this increase from the 1st of July in the VAT rate? So look, Saudi businesses will need to be very diligent with their VAT processes and compliance, I guess from 1 July. A 5% error for VAT was probably not the biggest issue. It was, for most businesses, it might be immaterial, but a 15% error is obviously significant. So 15% VAT is starting to move towards the higher VAT rates. I know from my experience, Australia has had a 10% VAT rate for 20 years. So 15% is quite significant. And it follows from that when you have a more significant tax liability, the penalties that can be imposed for errors are obviously higher. If you currently pay Saudi VAT, you should prepare for this rate increase by reassessing your budgets, so your financials, and that's particularly relevant for exempt suppliers, so that cost component becomes larger. You may need to make system changes to cater for the new rate percentage. If you're in the retail sector, you may need to amend your prices. If that has been a cost to you historically, you may need to revisit this, because you may have accepted a 5% cost, but a 15% cost might cause concern for the business. Ultimately, you should really speak to your VAT advisor to understand what exactly your business needs to do, and how you can put in a process now to make sure that this transition to this new rate is as smooth as possible. But if you have any questions, obviously feel free to ask them, and we'll get back to you.
I think just to add on to that, businesses should need to look at the contracts as well. For those of you who had hard-coded 5% VAT in addition to the price in your contracts, this amendment to the law may not be favorable to you. There might be some costs that you need to incur or have to pay yourself, simply because the customer will not pay anything more than the 5% that you have agreed in the contract.
Yeah,
so,
yeah. I mean, that would come down to contract drafting, how it's drafted, whether it's clear that the rate was, say, the standard rate and not with reference to 5%, because many contracts are drafted to say the prevailing rate of the time. So yeah, that's a good point. And that should just be in general with a bit of a review of your processes before 1 July.
One more point is probably on continuous supply as well. Because now basically you're going into a 15% VAT regime. So businesses also need to consider whether and how will it affect your business as a result of a continuous supply, straddling from June to July, if that's the case.
Yeah, and the cost it will have in your business.
Yep.
So moving now to, I guess, the more structured presentation. So as many are aware, the Gazette has extended the deadline for the filing and payment of VAT returns as a result of this amnesty that's been offered. So 2 lodgement periods have already passed. You've probably already taken advantage of it. The current month, so for April 2020, this VAT return is normally due at the end of the month, but now it is extended to the 31st of August. If you're in a refund position, the extension might not make too much sense to really take advantage of it, because you want to get that cash back into your business as quickly as possible. But if you're in a payment position, you will benefit from a cash flow benefit through the extension. So our suggested approach is proceed business as usual with the submission. You don't want to get behind on your VAT returns, but then try to take advantage of the delayed payment if you're in a payment position. Penalty waivers I think are probably the most commercially beneficial amnesty measure. So what this means in essence is that you can correct any errors that you've made in your past returns and not incur a penalty. So what normally would happen is if you find a mistake in a VAT return and that mistake has a net tax due which exceeds 5,000 reals, you need to notify Gazette within 20 days of noticing that error. If it's less than 5,000, you can correct it in your next VAT return through field 14. So there's no need to notify Gazette if the amount is less than 5,000. But say it is above 5,000 and you've notified of the mistake, if you have made an error and you notify before 30 June 2020, some of the benefits of this amnesty can mean that you can correct these mistakes without incurring any penalties, and you can submit and pay outstanding VAT returns without incurring the late submission or late payment penalty. And on the slide, we've set out what the saving is for each of these penalties. I won't go into them, but they can be significant if you have quite a large liability. So moving now to VAT updates. So in comparison to other tax authorities in the GCC, the Gazette hasn't released as many updates or guides in the past 12 months, but I think this is due to the fact that Gazette was pretty productive in the first year in releasing a lot of VAT guides, or the first 18 months, releasing a lot of VAT guides covering a lot of the, I guess, the general and common VAT areas. So probably didn't really need the additional guides. But nevertheless, there has been some releases in 2019 which are important to note. So the first and perhaps the most important is the change to implementing regulations. So in July of 2019, the VAT regs were amended, which were largely concerned with how non-residents interact with the VAT system in Saudi Arabia. So the first point is, and this point extends more to most taxpayers, I think, not just the non-residents, is when you have a local supplier who is supplying services to a customer who is not a GCC resident and going to the export of services rules. So initially, the rules were drafted so that there were a number of criteria to meet for the zero rating to apply. But now these rules have been flipped such that the starting point is that the supply of services to non-residents are zero rated. Then you have a number of exceptions. We'll cover these points in more depth in later in this webinar, so I won't touch on them too much now. Moving to tax representatives, so the rules were changed. Previously, non-residents were required to appoint a tax representative in order to register for VAT in Saudi Arabia. Now, non-residents are not required to appoint a tax rep. They can still do so, but they're not required, but they must appoint a third party to maintain the records in Saudi Arabia. Cash security and bank guarantees. So Gazette can always request a taxpayer to provide a cash security or a bank guarantee, which essentially ensures that the taxpayer has enough money to pay their VAT liabilities. However, the regs have been redrafted to provide specific rules for non-residents who have not appointed a local tax representative. These rules state that the amount of the guarantee decided by Gazette will now be based on double the average of the estimated quarterly output tax, rather than just the average estimated quarterly output tax, which is applicable to residents. With regard to records, so again, focusing on those non-residents, so a taxable person can always appoint a third party to comply with the record storage requirements. And this burden would fall on the tax rep of any non-residents. But as the rules have changed regarding tax representatives for non-residents, the record requirements have kind of followed, and they can be met by the non-resident appointing a third party in Saudi to comply with these record keeping requirements. Interestingly, the Gazette's processes, so their online websites and other documents, haven't been updated to reflect these amendments. So from a practical point of view, it's a bit of a struggle to apply these new rules, and there's a bit of, it can be quite vague and contradictory. Also, the implementing regulations that are on the Gazette's website that you can download are still the original version. So again, there's some confusion as to how these updates have been actually implemented. So looking at the guides now, and I'll hand over to Dale.
Yep. So in November 2019, the Gazette released a VAT guide on real estate investment and real estate financing. Essentially, it is very useful for property investors. It covers financing arrangements, including Islamic finance, which is typically not as straightforward as conventional finance. It is not a replacement for the real estate guide, which has since been taken down from the website, from the Gazette website. But perhaps the Gazette is doing this to update the real estate guide in order to be in line with the real estate investment and financing guide. At the same time, the Gazette has also released the VAT guide on investment funds, trusts, and estates. It is useful for fund managers and estate administrators. It provides useful information regarding the trust structures as well. And lastly, a guide on supplies of services to non-GCC residents. It basically outlines how the new rules work, which we will cover later in the webinar.
So moving now to the complex VAT issues. So in the last 12 months or 18 months or so, we've obviously conducted a lot of health checks and reviews, and from those reviews, we've taken some of the common areas where we've seen taxpayers struggle with some of the complex VAT issues. Obviously, we're not going to cover everything, and if your business has any niche issues or difficult issues, feel free to ask them in the Q&A, and we can always address them through that. But if we start now with bad debt relief.
So what happens when you sell something to a customer, you pay the output tax to Gazette, but in the end, the customer doesn't pay you? The question is, can you recover the VAT that you have previously paid to Gazette? And the answer to this is yes, only if you qualify for the bad debt relief. Now, a lot of taxpayers think this is just a matter of writing off the debt in your books and you'll be able to recover the output VAT. Always remember there are a number of conditions to be met before you can recover any VAT from Gazette that you have previously paid. So obviously the first point is you have to have already paid the VAT to Gazette. The consideration in respect of the supply of goods or services must be made to a person who is not a related person. Therefore, if you are supplying to a related party and they are not paying you, that's you can't avail the bad debt provision. It has to be at least for a period of 12 months that has passed from the date of supply. You must hold a certificate from your certified accountant indicating that the unpaid consideration has been written off in the books if the amount is less than 100,000 riyals. Now, in cases where the amount is more than 100,000 riyals, formal legal procedures have to be taken to collect debts without success, and you have to evidence these procedures, for example, a judicial ruling, evidence of the debtor's bankruptcy, or a court order initiating any other formal recovery procedure.
So from a practical point of view, some of the questions you could be asking yourself to kind of ascertain whether you have an issue is, firstly, does your company write off bad debts? And then what is that process for actually writing off the debts? Does your company create an allowance or a provision for unpaid receivables? And then if it does, how does that work with the bad debt relief rules? Have you recovered that on bad debts where you haven't met any of the criteria explained by Dal? So that's a common thing that we've seen in our reviews. Not all the criteria is met. It's very explicit, and you need to make sure that you do meet each of the criteria. If you have recovered that on bad debts incorrectly, you can correct this obviously before 30 June 2020 and try to take advantage of the amnesty on the penalties. So employee accommodation, does your business provide housing or a form of accommodation to your employees? Do you pay their rent expenses? Do you run a more intense camp for your laborers? And have you considered the VAT implications for all of this? So a supply of residential rental is an exempt supply where the property is a permanent dwelling designed for human occupation and the property is intended for use as a primary residence. So you need to meet both of those conditions for the exemption to apply: a permanent dwelling designed for a human occupation and the property is intended for use as a primary residence. So these rules will apply where you provide the rental accommodation to your employees. Gazette's employee benefits guideline outlines a number of scenarios, and we've found it's often the case that taxpayers have overlooked these requirements. So I'll step through the table that's on the slide. So this is straight from the employee benefits guideline. So when the employer's role is to provide accommodation for non-monetary consideration, so for example, in return for the employee fulfilling their duties as an employee, the VAT treatment of that supply of accommodation is that it's exempt, provided that the primary residence test is met. And you would value this supply at the fair market value. So that's when there's no monetary consideration. Providing that where the employer's role is to provide the accommodation in return for monetary consideration from the employee, so the employer is actually receiving something, so if they're receiving cash from the employee, the treatment is that the rent is exempt, provided again that the primary residence test is met, and you value that at the fair market value. So if you're receiving money from your employees that's less than the market value, you need to uplift that to the fair market value. If the employer is providing the accommodation for no consideration at all, then you're looking at the nominal supply rules or the deemed supply rules, and that will be exempt if the primary residence test is met, and again, you apply the fair market value. If the employer is not involved at all in the provision of accommodation, but just pays the rent, then there's no supply made by the employer here. They're essentially paying the consideration for a supply made by, say, a landlord. So there's no supply in that circumstance. So look, if you're providing your employees with free accommodation, you really need to consider a few things. So is it actually truly free, or am I providing it in return for the duties as an employee? Because it's going to impact the VAT treatment of your supply.
So some practical considerations for businesses would be, if you actually provide employee accommodation, question is, have you been reporting your supplies correctly in the VAT return as an exempt supply? If you're making an exempt supplies though, have you been restricting input VAT on your exempt rental? Have you considered annual partial exemption as well, which is typically not straightforward? It is also important to note that if the accommodation provided do not meet the primary residence rule, perhaps the VAT rule should apply. The default VAT rule should apply, which should be typically 5% in this case. And now let's move on to
finance leases. So when will this be applicable? So when is a finance lease applicable? So are you providing equipment under a long-term lease? Do you lease equipment yourself under a long-term lease? And is there an option to purchase the goods at the end of that lease? So where a lease contract provides a customer with an option to acquire the goods at the end of the term of the lease, and the parties generally expect that the customer will exercise this option to purchase, then that transaction will actually be viewed as a supply of goods. So the implications of this arrangement is that VAT will be triggered on the sale of goods right at the start of the lease. So you need to look at your time of supply rules. So VAT will be payable when the goods are delivered. So if the VAT component on the sale of goods is payable to Gazette right at the start of the lease, then you need to factor that in and how you're going to fund that VAT. So obviously it's a cash flow issue because you generally under a lease agreement, you receive the consideration in installments. So you need to make sure that you have enough money to pay for the VAT right at the start. So in addition to the time of supply rule, you also have to consider the VAT implications of the financing component. So any margin earned on that lease is VAT exempt. So how would you manage this cash flow position? So you've got this lump sum VAT payable, which is on the value of the goods supplied. What you should do is ensure that the first installment is sufficient to cover the VAT payable. So then you're not left out with out of pocket to pay the VAT to Gazette.
So some of the practical considerations here is, have you accounted for output VAT upfront? Now, as Mark mentioned earlier, obviously this will be a cash flow issue as businesses may be out of pocket until the amount, the VAT amount is received. Perhaps consider changing your payment terms for future contracts. The next one is, have you reported exempt supplies for interest or margin component? Have you considered again the partial exemption as well as the annual partial exemption calculation? So these are the common mistakes that we found again, during our health checks and reviews of VAT returns. Now let's move on to retention payments. Retention payments are basically amounts which are held back or retained until work has been certified to be complete. They are commonly used in construction contracts and long-term development projects. This type of contracts are generally viewed as continuous supply due to the milestone payments and progressive payment basis, and therefore the time of supply rule for continuous supplies should apply. And in this case, the retention payment will form its own time of supply event. There are also instances where the retention amount does not have a time of supply in itself. It's merely a commercial agreement between the supplier and the customer. A certain percentage or amount will be withheld until certain criteria are met or when the customer is satisfied. Now, it is important to know that the time of supply in such cases would have been triggered at the time the milestone payments, the respective milestone payments are due, notwithstanding the fact that the retention amount will only be paid by the customer in the future date. Now, this may potentially pose a cash flow issue, of course, to the supplier, as the VAT amount would have included the retention amounts VAT which needs to be paid upfront. Now, just to recap, like any supply, you need to consider the contract and conclude that the supply is continuous supply and that the retention payment is not a separate supply in itself, such that the time of supply rules for discrete supply applies. A couple of questions. What if the retention payment is due 3 years after the services commence? Now, for continuous supply, when no payment is received, no any invoice is issued, which is the normal time of supply rule, the supply is deemed to take place on the date following 12 months after the date, the supply date, the supply commencement date, or the date the last invoice was issued or payment was received. So you will need to look at the retention payment deadline with reference to the last time of supply that was triggered. Now, essentially, for those of you who has projects with periodic installments or milestone, you will need to monitor the 12-month rule very closely.
I think this point is often one that's overlooked because you need to consider the continuous supply rules. So we've got them on the slide, and it's the time of supply is the earliest of when a tax invoice is issued, when payment is received, or it's subject to this 12-month rule, which basically says that the tax point crystallizes 12 months after the last tax point was crystallized. So you can have a retention payment that's due, say, 3 years after the services have commenced, or maybe due 2 years after the services have been completed. But you're not paying the VAT when the retention payment is due. You're actually having to pay the VAT 12 months after you've completed the last installment. So you can often have this VAT liability sitting out on its own well before the retention payment is actually due. So it can cause issues for both compliance and making sure you keep track of this VAT payment, because you don't want to charge it again on the retention payment, as well as, I guess, a cash flow issue as well.
Thanks, Mark. So what about non-payment of retention? So when customer does not pay the retention amount to the supplier, for example, due to a dispute about the quality of work or the contractual terms have not been satisfied, VAT will not arise on the retention amount. So if you have already accounted for VAT on the retention amount, for example, by issuing a tax invoice or when the 12 months rule applies, you may have to adjust the output tax by way of issuing a credit note as the value of the consideration has since been altered. Now let's have a look at input tax recovery on employee-related expenses, which is an interesting one and obviously commonly discussed among peers. Now, firstly, as you guys would know, in order to claim any input tax incurred, it has to meet all the general input tax rules. The first point being you must be registered for VAT, making taxable supplies, incurred in the course of furtherance of business, in possession of valid documents, for example, invoices, customs bayan, credit debit notes. And the input tax incurred is not specifically blocked as per the KSA VAT law. There are a lot of ambiguity surrounding input tax recovery on employee-related expenses, and fortunately, Gazette has shed some light on these input taxes, on certain activities that are claimable and actually non-claimable.
So looking at the claimable input tax, the first point is that any VAT incurred in fulfillment of a statutory obligation is claimable to the extent of the minimum requirement as per that that law that governs that statutory obligation. So the key example here is medical insurance. So if this is required to be paid under, say, the labour law, then you can claim it. But it's important to note that any additional VAT, any VAT incurred on additional policies that you subscribe to, that's in addition to that minimum requirement, will not be claimable. So say, for example, you have a basic medical insurance policy for the majority of your staff, but then you offer a more complete or complex policy for your executives level, then that policy that goes above the labour law requirements, that you can't recover the VAT on that. So similarly, you see issues around medical insurance for family members or dependents, and you always need to go back to the labour law or whatever law governs that statutory obligation. It's not enough to just look at the employee contract. Gazette considers that pantry items, so a pantry which does not provide meals, only offering hot or cold drinks, reheating facilities and similar, will not in itself be considered a venue which is similar to a hotel or restaurant, and therefore the input tax will not be restricted in that circumstance.
So let's have a look at some non-claimable input taxes. Obviously, the first point is the private use. Anything that you incur for private purposes will be non-claimable. Costs incurred, so some examples include cultural events, sports club, and etc. It is important for businesses to identify these expenses incurred, which are private in nature, in order to restrict the input tax claim. Again, this is a common mistake that businesses at times have missed out. Generally, businesses just includes most input taxes as claim, and always remember, if you claim input taxes that you shouldn't, you will be penalized. Next up is in relation to motor vehicles, and Gazette has clarified the input tax claim is restricted for motor vehicles, including its fuel and maintenance, made available for private use. Now, what it means is no apportionment can be made to claim the business use portion only for motor vehicles. Now, the entire amount is restricted from input tax claim. It is important to know that there is no specific rule to govern what constitutes as private use. Each scenario has to be looked at on a case-by-case basis. Now, for example, if a car is required to be kept at an employee's premise outside working hours in order to travel to and from work, may not be considered as private use, depending on the context and circumstance. If at all you intend to claim input tax on expenses incurred on motor vehicles and its related expenses, again, meaning the vehicle is actually not made available for private use, you should always retain evidence that you carry out regular checks to enforce such restrictions on employees. For example, issue reminders to employees on the purpose or on the restriction on vehicle use, internal audit records of vehicle usage, and etc. Now let's move on to catering. Input tax incurred on catering services is specifically disallowed as per the KSA VAT legislation. For example, assuming you won a big sales contract and as a reward to your sales team, you decided to bring them to a restaurant. During the course of dinner, you have also discussed with your team your future business plans. While the dinner is arguably connected to your economic activities, since it is specifically blocked in the legislation, you are obviously not allowed to claim. The restriction includes the provision of meals, including incidental expenditures, for example, cost of cutleries, cooking equipment in an on-site cafeteria or canteen, or any meals consumed by employees at restaurants or similar establishments during the course of their work. However, if the employees are charged for the meals though, then input tax should be deductible. A point to note here is that as employees are considered as related parties for VAT purposes, the charge made to employees should be at fair market value for VAT purposes. As if you are transacting with an unrelated third party, and remember there is a requirement to issue valid invoice for deemed supply. You may not issue to the employees themselves, but you must keep all invoices and ensure it is easily accessible and made available to Gazette upon request. The last point is on the cash benefit for housing and accommodation, and Mark has already explained in the previous slide, and I will not elaborate further in this case. In essence, it is important to know what is the employee's role in the arrangement in order to ascertain the relevant VAT treatment.
So adjustments to VAT returns. So if you've made a mistake in a VAT return, what do you do? So it depends on the quantum of the error. So if your error is less than 5,000 reals, you can use field 14 of the next VAT return. So it's just a normal correction. If the error is greater than 5,000, you need to notify Gazette within 20 days of becoming aware of that error. So what does a notification look like? So it can be as simple as just submitting an online electronic correction of the VAT return through the portal, and you can make that correction in the adjustments column. Or it can be something more formal in the sense of a formal voluntary disclosure. So what I mean by that is it's a more formal submission that explains what the mistake was. You can make submissions for why no penalties should be imposed, and maybe explain the measures you've taken to ensure that that error doesn't happen again. So I guess that would probably be more appropriate when the quantum of the error is quite large. If you've made multiple errors exceeding 5,000, what can you do? So you can either correct it in each affected tax period separately within 20 days of becoming aware of that error, or you can submit a single notification via the Gazette online portal covering all the tax periods in error. What about errors on the input tax side? So if you've overclaimed input tax, if you overclaim input tax, it's similar to an output tax error. If you've forgotten to claim the input tax, you obviously have 5 years to claim it. So looking now at exported services. So we touched on this briefly at the start when we were talking about recent updates. So the rules changed around the VAT treatment of zero-rated exported services when the regulations were amended in July 2019. So the starting point now is services provided by a Saudi Arabian resident to a customer without a place of residence in any member state is zero-rated unless certain exceptions apply. So these exceptions, they're listed on the slide. So the first one is if a special place of supply rule applies and under that rule, the place of supply is Saudi Arabia. So some examples of special places of supply rules are where you lease a means of transport to a non-registered customer, when you have real estate related services, for goods and passenger transportation, as well as telecommunications, electronically supplied services, as well as services that take their place of supply based on actual performance. So catering, educational costs and services supplied at the actual performance. Another rule is to do with the customer is a resident in any member state. So what that means is basically you can't zero rate when your customer is a resident in Saudi Arabia. Thirdly, the customer or a person benefiting directly from the services is in Saudi Arabia at the time the services are supplied. If that supply is made to another person, then that other person must not be entitled to recover that in full. So what this is getting at is you can make a supply under your contract to a contractual customer, but actually deliver it to a different person entirely. You need to look at where that other person who benefits from that service, where are they? And are they entitled to recover that in full? Finally, services relate to tangible goods in Saudi Arabia would also be an exception.
So some practical considerations here is, who am I providing the services to? Who is the actual recipient? You may have a contract with an overseas head office, but deliver locally to a local subsidiary. And in that case, what is the VAT treatment? As an example, in this case would be an overseas head office engages a global advisor to provide advisory services to all of its subsidiaries around the world. A specific advisor is required by the local entity located in KSA, and assuming only KSA office is able to provide such services, for example, an audit. Now, it is important for the supplier located in KSA to identify the party who will be benefiting from such service. And in this example, the customer's office located in KSA. As a result, the supplier will not be able to zero rate its supply, notwithstanding the fact that the contractual or billing party is located outside KSA. Now, just to recap, it is important to consider whether there are any other parties located in KSA is actually benefiting from any services which may be zero rated by virtue of the fact that the contractual party is located outside KSA. And the last VAT complex issue is on direct and indirect export of goods. So what is direct export and what is indirect export of goods? So a direct export is when the supplier arranges for the transport of goods to a place outside KSA, and for the time being until the ESS is in place. And indirect export is when the supplier does not arrange for the transport of goods, but a third party, it may be the customer, it may be the freight forwarder appointed by the customer, arranges for it. The documentation requirements in order for the zero rate to apply are, obviously you need the customs export document, commonly known as bayan in the region, transport manifest evidencing the place of delivery or the port of destination. So for example, your bill of lading, commercial documents such as commercial invoice, packing list, and etc. Now the other requirement is that the documents must be obtained within 90 days from the date of supply. It actually also means that the goods have to leave Saudi Arabia within the same time frame in order for zero rate to apply. It is important to know that if the documents are not received or goods are not delivered within 90 days, the general VAT rules applies, depending on whether your goods are subject to VAT at 5% or 0%. Now, typically, businesses will engage with third-party freight forwarder to sort out the logistics, and the businesses should always consider setting up a process with the freight forwarders to ensure documents are received in time. And this is particularly important for import VAT as well, for import VAT claim purposes. So you need to make sure you have the import bayan before submitting your claim in your VAT return.
Looking at indirect exports, so these are more complex than your normal direct exports. So an indirect export is where the supplier does not arrange the transportation of the goods. So Gazet's view is that an indirect export of goods can only be zero rated when 1, the supplier is listed as the exporter of record or is named as the exporter on the customs documents, or 2, the export is facilitated by or on behalf of a non-resident customer who is transporting the same goods out of Saudi Arabia as a result of that same supply. So if the customer who arranges the transport is a Saudi Arabian resident, then the supplier cannot zero rate their supply.
And the last question here is, do trade terms or Incoterms play a role in determining VAT treatment? Now, it is important to note that while trade terms or Incoterms do not necessarily determine VAT treatment, it provides an indication as to which party is liable for the transport of goods, where the risk or reward or title of goods is passed on to the customer. Now, the commonly used Incoterms in the region are ex-works, DDP, delivery duty paid, deliver at place, DAP, and etc. Each of them has a different risk and reward structure, which helps in determining the appropriate VAT treatment. For example, if goods are delivered to a foreign customer on an ex-work basis, meaning the goods are made available to the customer outside the supplier's warehouse, 5% VAT should be applicable, and unless the indirect export rule applies. While export of goods may sound relatively straightforward, by basically just applying 0%, it is important to consider other factors as we have already covered earlier. Based on our experience, oftentimes trade terms or Incoterms are not used correctly, and it is merely used for pricing purposes only. Therefore, while Incoterms may be a good indicator, it is important to look at the contract in order to ascertain the place of transfer of ownership, for example, in order to assess a particular or the VAT treatment. Now, of course, there are other instances where goods can be exported for various reasons. For instance, export of goods without sale, re-export of imported goods, and so on and so forth, which unfortunately we will not discuss today. Now, we have an indirect tax team working on GCC indirect tax matters, and we are happy to talk to you if you require any assistance in this. And I guess this should conclude our discussion
on the complex VAT issues. So I noticed there's been a couple of questions on the Q&A throughout the session. Mabeen or Omar, did you have any that you wanted to read out, or any common issues?
Hi. Yeah, so look, I think I'll start off. We've answered some of these questions already, but I think it'd be useful to go through some of these. So one of the questions that was asked was, with the VAT rate increase, will this be applicable to goods and services supplied post 1 July? So not invoice date driven, but date of supply driven. And look, the answer is that it is supply driven. So you'll need to look at contracts that straddle past the 1 July date and look at when you're actually making the supply. So if you're providing services, then you will need to look at the component that's being provided post 1 July and the bit that's provided pre 1 July and make the change. One of the interesting points is that obviously if the VAT rate's going up, then you'll need to collect the extra VAT from your customers. So you need to make sure that your contract allows you to do that. Generally, contracts should have a more generic VAT clause that just say that VAT, the applicable VAT rate will be charged. If it's actually hard coded, then you may have problems, as Mark mentioned earlier on as well. So it's an important point to consider as we move towards this new VAT rate coming in effect from 1 July. Omar, any other questions you want to go through?
No, I think the recent updates on the tax rate is actually very interesting because we've got a lot of customers or clients, especially in the banking and insurance sectors, who will have issues in relation to the supplies that they're making right now. Reason is because just on the UPR alone, UPR stands for unearned premium. So there will be a huge liability that they will need to look into if they don't do this correctly. Another point that I want to mention as well is that given that we have tax amnesty at the moment, businesses should fully capitalize this window to assess whether there are any gaps. Because see, previously 5% of VAT may not be material to most businesses, but now 15% can be quite substantial to businesses, So looking into the current gaps of the business and see whether there are any tax points that will put you in bigger problem in the future.
Okay, so there's another question that's a couple of questions that still haven't been answered. So look, one of the attendees has asked a question, why is the VAT rate increasing by so much? And this is a 200% increase. Look, unfortunately, we as advisors cannot tell you why the rate is increasing. I think the fact is that there's various issues at play at the moment, like COVID-19 and obviously pressure on oil prices. So obviously the Ministry of Finance, the government in Saudi has decided that a rate change is necessary to increase revenues for the country. So that's really the reason behind the rate change. There's another question that says, I'm just going to read it out. Please explain if a PE, so a permanent establishment in Saudi Arabia, provides services to customers outside Saudi, but within the GCC. So let's say to Bahrain or to the UAE. So a permanent establishment providing services to customers in, let's say, Bahrain. And I think the question is the place of service is Saudi. Will that be considered at the zero rate? So, Mark, do you want to step through sort of the zero rating conditions?
Yeah. So that's getting at the change in the regulation. So the starting point is if you're a Saudi resident supplying services to someone who's not a Saudi resident, then it is zero rated, unless the exceptions which we had listed on the slides apply. So I could probably go back to some of those, the actual requirements actually. So firstly, you've got your special place of supply rules. So I'm not sure of what the services you're providing are, but consider the special place of supply rules. So say, for example, they're architecture services related to building a house in Saudi, but you're providing it to a customer that's overseas. Then the real estate related services should kick in and the place of supply would be Saudi, so you wouldn't be up to zero rate. So you need to really go through what services you're providing and whether there's a special place of supply rule. Another exception is where the customer is resident in any member state. So that's what the law says. And I think that's where you've got the confusion around if I have a customer who's not in Saudi, but is in another GCC country, can I still zero rate? Read member state now as to just mean Saudi. So the Saudi law, as well as the other GCC VAT laws, are not recognising the other GCC countries as being GCC implementing states at the moment. So just read that as Saudi Arabia. So if your customer is a resident in Saudi, then you can't zero rate. If your customer is present in Saudi Arabia when you perform your services, you can't zero rate. So that might mean is, say you're providing say legal advice to someone in Dubai, but they fly to Saudi to hear you present the advice and formally deliver the advice, then arguably in that circumstance, the person who's benefiting from the services, the customer, is present in Saudi when you're performing your services, so you can't zero rate. You also need to look at, is my contract with a customer that's overseas, but am I actually delivering the services to someone that's present in Saudi? So say, for example, you have a contract with a head company who's headquartered in Dubai, but they have a subsidiary in Saudi, and you've contracted with the head company in Dubai, but you actually do all your services for the Saudi subsidiary, or you go to their offices and help them with whatever you're engaged to do. So in that circumstance, it could be arguable that another person is benefiting from that supply and that person's in Saudi. You would then need to look at, can that other person fully recover input tax? So are they fully taxable? If they are, then you don't need to worry about it. You can zero rate. If they're not, then you need to, you obviously don't meet the zero rating rules. So you will need to obtain evidence from that other person that they can't recover input tax in full. And finally, the final exception is, are your services in relation to tangible goods in Saudi? So say you're providing advice on a large piece of machinery or operating machinery, then it clearly relates to tangible goods. If the goods are located in Saudi, then you can't zero rate. So to answer your question, the starting point is if your customer's outside, it's zero rated, but you need to look at all the exceptions and how they apply to your facts.
Mark, I just had I think it'd be useful to go through, like, let's say if I'm a business in the retail space, what are some of the issues that I need to start looking at now with the 15% rate change coming in? What are some of the key things that I need to start looking at leading up to 1 July? There's not much time left, so what do I do?
Yeah. No worries. That's a good question. So practically what you would do is, firstly, you've got to sort out your prices. So if you're selling things that are subject to that currently at 5%, that's going to change to 15%. So you need to look at your pricing. Remember, you need to display your prices inclusive of that. So all your displayed prices will change. So you need to factor that in. You might need to update your tax invoices to ensure that you can actually cover the 15% if there's a character limit, for example. Other things you can consider is just the general cost impact that it will have. So if you're purchasing items that you then on-sell, is the cost of that then going to uplift now by 10 up to 15%? So you need to consider that and how that cost impact will happen on your business. So there might be a cash flow implication. You might be fully taxable, but it might take a few months to recover the input tax that you've paid. So there's just a couple of things that I think businesses in the retail sector need to think about.
Cool. So a couple of more questions. We've got, what is the treatment of supplies of services if the client is based outside Saudi Arabia while the billing is made to its local entity, i.e. in the same invoice, the mention is, it's mentioned the foreign entity's name, but care of the local entity. So it looks like the supply is actually to someone outside, but just the billing is being done locally.
Yeah, I think that's going to be applicable on the supplier. The billing is kind of ancillary to that, in my view. So the billing doesn't really impact the VAT treatment of the supply. So at the starting point, if you're billing to a local entity so that local entity can recover the VAT and it's not a cost to this foreign entity, then you're probably not doing it right to begin with. So that's probably something to consider. But if you're, for these zero rating rules, you need to just go back to the criteria that we outlined on the slide. So who is your customer? Are you actually providing it to this foreign entity, or are you actually providing it to this local entity? And what relationship do you have with this local entity? So I think you need to consider the type of services you're providing and whether it meets that zero rating requirements. But I think there's that overarching issue of whether you're actually invoicing correctly at the moment, and whether your recipient the billing entity in Saudi can actually recover that input VAT, because arguably they're not the ones who have actually purchased the service.
Another question that was there, which we have answered on the Q&A, but just thought people may be interested to hear about it. So the point 3 that you discussed when you're talking about the zero rating rules, is it similar to the Article 31, subsection 3 of the UAE VAT ERs? And I think the answer to that, yes. I mean, the zero rating provision in KSA seem to be aligned with the UAE zero rating provisions.
I think just to add on to that, generally the zero rating rules for GCC should be similar in this instance, except now in KSA, obviously the default position is zero rating or zero rated unless certain exception applies, and these exceptions are indeed similar or aligned to Article 31 of the UAE VAT rules. This is obviously to make sure that the GCC or the implementing states, or the member states for that matter, are in line in terms of interpretation of the zero rating rule.
Okay, look, I think we've come to the end of the webinar now, so we'll end it there. So thank you all for joining us today. Pleasure having you, and the surprise announcement today is, I think, come at a interesting time. Lots of changes happening, oil price decreasing in Saudi, COVID-19 issues. So this is going to impact businesses a lot. There's a lot of work now to be done for businesses. It's not just saying, okay, well, let's just flick the switch and change it from 5 to 15. You're going to have to actually look at issues around contracts, look at your input tax recovery, look at maybe doing a health check to make sure that you're not making any errors, because a 5% error was not a big deal in the past, but 15% error is going to be a big deal. So it's really interesting times for everyone. So thank you all for joining us. Cheers.
Thank you, everyone.
Thank you.